Hello friends, this is Vijay Bhambwani and I'm back with you in this weekly market outlook video. I hope you had a good week last week and you enjoyed the pullback that the markets gave. Is this what you call a Santa Claus rally? Is December customarily a month where institutional buyers prop up the markets? We're going to find this out in this video. So let's plunge right ahead, and coming up on your screen is the market roundup window, which shows that the rally was actually led by the banking sector, and there were whispers on the street that there was likely to be a proactive process of privatizations of public sector banks and disinvestments in other PSUs. So the banking sector actually gained and led the way. Nifty underperformed the Bank Nifty in relative comparison. Gold rose whereas silver fell. The US dollar index, the Dixie, was mildly weaker, although just about, which added to the cheer in Indian equity markets. Oil rose on short covering, whereas natural gas fell. Now, the USD INR jumped, which is noteworthy at a time when the US dollar index fell, which means the Indian rupee weakened against the dollar at a time when the dollar itself was marginally weak. Now, this is something we are going to have to monitor in the week ahead. The 10-year benchmark bond yield was unchanged. The National Stock Exchange saw a gain of 2.13% in market capitalization, which is routine considering the fact that the markets gained. Now, the MWPL, or the market wide position limits chart, shows a rise, which is along expected lines, and the rise in MWPL usually sustains till the third week of any derivatives series. The turnover chart on your screen shows the volumes were lower on a week-on-week basis. And the volumes on both the index and the stock futures were subdued due to the unusually high volatility. Now, as the Christmas holidays approach, volumes are expected to fall mildly, which is because the FIIs will, as Christmas approaches, withdraw from the markets temporarily. Now, this has implications for you and me as traders. It will raise the bid and offer spreads and make trading that much more challenging. Now, let's take a look at the basis chart, which shows the futures premium over spot. The basis chart shows a small gain on a week-on-week basis, and this was seen across both the indices, Nifty and Bank Nifty. And this was because the bears were pushed to cover their shorts. Now, the basis over a period of time starts to compress as expiry approaches. So I do expect a gradual decline in the futures premium over spot in the coming week. Now, for the study that you have come to rely upon so steadily over the months, our exclusive in-house impetus chart, which shows that the bullishness last week in the headline indices, the Nifty and the Bank Nifty, was actually on lower impetus on a week-on-week basis, which means that there is a higher probability of short covering and low conviction buying that has boosted the markets higher. Ideally, I would want the price and the impetus to rise together before I can say that the rally will sustain. Although there is a small comfort that the fall in impetus has tapered off, but I would want a whole lot more rise in the impetus chart along with the price before I could go out and start buying again. So watch this space in the weeks ahead. Now, let's take the footprint of four types of players in the market, starting with the FIIs. The FIIs index net long positions fell a little to 55,829 lots, which was last week at 59,411 lots. Their stock futures longs went up marginally to 1,58,906 lots, which was 1,56,856 lots. Where DIIs are concerned, their index net longs were at net shorts, were at 67,571 lots as against a net shorts of 70,262 lots. So the DIIs have marginally covered their short positions in index futures. Where their individual stock futures net shorts are concerned, they reduced some amounts of net shorts in individual stocks also, which were at 16,71,895 lots as against 16,73,202 lots. Where proprietary traders are concerned, their index net short positions rose to 17,418 lots, which was last week at net short 1,306 lots. Where their individual stock futures positions are concerned, their long positions were reduced marginally to 2,728 lots, which last week was 2,06,464 lots. Coming to the retail segment, the index net long positions rose up to 29,160 lots, which was earlier 12,157 lots. Their individual stock futures long positions also rose very marginally to 13,12,261 lots, which was earlier 13,11,677 lots. So what we are seeing is that prop traders, who are the next best thing to insider traders because they are brokers, own proprietary trades, they've reduced their net long positions, which is telling you that this should be a sign for cautious optimism. Let's now go to the 10-year benchmark bond yields, which remain steady because the RBI Monetary Policy Committee decided to keep interest rates unchanged. The marketplace, however, saw interest rates rise due to hesitation by the big ticket check writers in deploying money in fixed income instruments at lower rates, which are yielding now, especially in the view of rising inflation, which is a challenge. World over, interest rates are going up, and I would watch the Bank of England in its forthcoming meeting. If it raises rates higher, it would be the first big economy out of the big four to do so. Now, that's the trigger that I would keep my ears to the ground. Meanwhile, the German bond yields continue to sink deeper and deeper into negative territory, which is a big red flag, because Germany is quite simply Europe's strongest economy. Now, the coming year, 2022, may see higher coupon rates, interest rates, because that's going to raise the cost of funds even higher. And this is possibly likely to see reallocation of funds from equity to debt instruments to a certain degree. This is something that I warned you even last week. We need to watch out for these signs in the coming year, and I'm going to keep you updated. So stay in touch with me, connect with me on social media. My contact coordinates come at the fag end of this video. Friends, we now go to the US dollar index, the Dixie, which lost 0.1% on a week-on-week basis. Now, this index saw consolidation last week. Had it risen, our equity markets wouldn't have been as cheerful as they were. Now, this index rallied on 3 out of 5 trading sessions, but the falls on remaining 2 sessions were sizable enough to cap the weekly gains. The price remains above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. The short-term outlook remains positive as long as the price stays above this average. Now let's turn to the weekly chart, which shows another doji as the open and close were fairly close to each other on the weekly range. Now this is a sign of indecision, a tug of war between bulls and bears. Follow-up action is required to set the trend in motion hereafter. Last week, I advocated a range between 97.15 and 95.05, which held beautifully. And the coming week may see an estimated range between 97.05 and 95.05 again, because of the very mild change on a week on week basis. Watch this instrument for trend determination on commodities, equities, and the bond markets. Friends, I now come to the Bank Nifty, which gained 2.51% on a week on week basis after rising on 3 out of 5 trading sessions, and it outperformed the Nifty in relative comparison. The price went above the 25-day exponential moving average on the daily charts but settled a little low. And this exponential moving average is a proxy or equivalent of a month-long holding on cost of a bull. We need the price to rise and stay above this moving average for roping in the retail trader on the buy side again and changing the outlook to positive in the near term. Let's take a look at the weekly chart, which shows a larger bullish candle as compared to its previous week. And the week's close is above its 25-week exponential moving average, although by a very small amount, by a whisker. Now, this hints at a possible pullback rally because December is usually seen as a Santa Claus rally month. Santa Claus rally because FIIs have their year ending in December, and to prop and boost their NAVs, they usually resort to buying. And don't forget, the DIIs also have a quarter ending, third quarter ending, and they also join in with the FIIs to buy, which is why it's seen as a Santa Claus rally in December. Will this year see a Santa Claus rally month? I do think that is a possibility, which is why the markets have risen last week in the first place in spite of all the negativity. Now, the rumors of aggressive public sector bank privatization also helped in boost sentiments on the Bank Nifty. Let's turn to the weekly chart, which in the week before last, this index was number 3 on the highest beta list, which is volatility. But it moved up one notch due to the rise in beta. Now, that's a challenge. You saw the sharp and large moves on this index in the week gone by, which is why I continue to advocate you trade on light exposure and keep your stop losses diligently. Last week, I advocated a range between 37,725 and 34,600, which held perfectly in spite of all the volatility that you saw last week. And the peak was at 37,398, almost 1% below its expected resistance. Now, in the coming week, I expect an estimated range between 38,650 and 35,550. I remind you to trade light. Friends, let's now turn to the Nifty 50, which gained 1.83% on a week-on-week basis, and it began the week with a slam dunk decline on Monday, but it rallied on 3 out of 5 trading sessions thereafter to notch weekly gains. The weekly dollar index helped, as did the steady bond yields in propping up the Nifty. The price managed to close above its 25-day exponential moving average, which indicates a month-long holding on cost of an average bull. Now, this is the first early sign of relief to the buyers. We need the price to stay above this exponential moving average with rising impetus chart to continue with an up move. Remember what I told you in the Bank Nifty segment, Decembers are a month for Santa Claus rallies, and the upthrust last week can be partly attributed to the same. The weekly chart on your screen now shows a larger bullish candle as compared to its prior week because the buyers showed more conviction compared to the previous week. The price is above its 25-week exponential moving average, which is a proxy for 6-month holding on cost of an average bull. So the medium-term outlook is also positive for now as long as the price stays above this average. We, however, need a sustained trade above the weekly high at 17,543 levels to trigger the next round of buying. In the week before last, this index was number 9 on the most volatile list, but it rose one notch to number 8 highlighting the higher volatility challenge. And I expect the beta to only rise as December end comes closer, because volumes will fall as FIIs withdraw and spreads will widen. Last week, I advocated a range between 17,700 and 16,650, which held perfectly well in spite of all that volatility. Next week, I expect an estimated range between 18,025 on the upside and 17,000 on the downside. The view to trading light remains even for the week ahead, and I do remind you to keep your stop losses very diligently. Friends, let's now come to the most popular segment of this video, wherein I give you 5 stocks with high impetus, high beta, high volatility, where you take small exposure, wait for big price moves, and 5 stocks with low beta, low impetus, where you take big exposure and wait for small price moves. Why the difference? Because different traders, different attitudes and aptitudes, therefore different techniques. Now, the high beta, high impetus list is led by Dixon at number 1, number 2, Granules India, number 3, Aurobindo Pharma, number 4, Pertinent LNG, number 5, Biocon, and the low beta, low impetus list is led by HAL, Hindustan Aeronautics, number 2, Bandhan Bank, number 3, NTPC, number 4, Trent, number 5, NAM India. Friends, this hierarchy can change day to day, hour to hour, because the volatility expands and contracts on an everyday basis. So do connect with me on social media. My contact coordinates come at the fag end of this video, and keep yourself updated. Also, in the description below this video are hyperlinks to my Equity Master playlist on their YouTube channel. Do subscribe to that playlist and watch a couple of ideas that I share every week there. And is also an hyperlink in the description for a PDF trading guide from Equity Master. Do download that and avail of this offer. I thank you for your patience and watching my video. I wish you have a very, very profitable week ahead. Do subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know your thoughts on the work that I'm doing here on my YouTube channel, and refer my videos to your family and friends and help me reach out to a wider audience of people. Thank you for watching. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.